Welcome to the MUFG Global Markets FX Week Ahead podcast with Lee Hardman, Senior Currency Analyst at MUFG. It's Friday, the 6th of June 2025, and joining Lee to pose some questions on the financial market themes for the week ahead is Simon Mays, Head of UK, Ireland and Switzerland Corporate Sales, FX. The following podcast is intended for professional investors and eligible counterparties only, and not for retail clients. Any content should not be regarded as an offer to conduct investment business or an investment recommendation, but for information purposes only.
Hi Lee, it's always really good to catch up with you. I've got a few things I wanted to cover from this week. It's been a busy week, so I'd love to get your view on a couple of things. So first of all, let's start with the obvious data and market focus this week, the US non-farm payrolls. Dollar was much weaker, or was weaker for much of this week heading into the data, and the ADP data earlier in the week obviously helped that as well and helped to quash expectations of a larger than expected print in non-farms. But the print came in slightly higher than expectations, but further revisions lower to last month's print. Was there anything in the data you could pick out as particularly interesting? Where do you think we stand for further US rate cuts as well, post non-farm payrolls? I'd love to get your view on that, please.
Yeah, no, like you said, Simon, I think the market was very closely focused on today's payroll data and was anticipating a much weaker report after the soft ADP survey that we had earlier in the week. And even though today's report did show a further kind of slowdown in terms of employment growth, I guess for the market and for the Fed, the main kind of takeaway is that even though employment growth is slowing, it's still slowing only modestly. And it's not, the labour market is not loosening significantly at this stage. If we look at, say, the unemployment rate, that's continuing to kind of consolidate at just over 4%. So for the Fed, there's nothing really in this report that would really kind of trigger them to think more seriously about cutting rates at upcoming policy meetings. So for the market, I think it basically kind of solidifies expectations that the Fed's likely to remain on hold, probably at least until, say, September, unless we get a really bad kind of payrolls report for June, which you can't completely rule out, but the most likely scenario in our view is that the Fed's likely to be on hold at least through the summer period. So that has prompted some kind of hawkish repricing of Fed rate cut expectations, lifting two-year Treasury yields today by almost 10 basis points. Obviously, when you see that kind of size move in the short-term US yields, you would expect the dollar to bounce back, and that's what we've seen today. But we'd still say if you look at the scale of the dollar rebound, it's still fairly modest. So to us, it doesn't really change the kind of weakening trend for the dollar that's been in place this year. It just gives the dollar a bit of relief after some, like I say, selling earlier this week.
And more calls on Twitter from Trump for Fed rate cuts, 1 percentage point he was calling for, I think, earlier on, despite claiming that the American economy is hot, but I don't think he's going to be able to persuade them. Not yet, anyway. I guess secondly, then the other hot topic was US-China relations again. Trump and Xi holding a 90-minute call, and afterwards some positive rhetoric regarding a trade deal from Trump post the call. But it doesn't seem like the market's reading too much into that at the moment. Do you think that's right, or to be cautious about what we're hearing on that? Or do you think, any chance of a shift in that soon?
Yeah, I think with Trump, it's always difficult to kind of have a strong view about what's going to happen next. But I guess the phone call yesterday kind of plays into the kind of recent positivity amongst market participants that Trump looks like he's obviously looking to kind of strike deals with other countries, and that it's kind of giving market participants the kind of impression that he doesn't really want to keep these higher tariffs in place if he can avoid it. So that's certainly giving the market more optimism that the global economy can perhaps avoid the worst case scenario in terms of a sharper slowdown from this tariff disruption. And that certainly has been helping risk assets to stage a strong rebound since the lows back in April after his Liberation Day tariffs announcement. This week, we've seen kind of global equity markets rise up to fresh record highs, and that improvement in risk sentiment has been playing into the FX market. So if we look at recent FX market performance, it's really the kind of high beta commodity GDN currencies, the Aussie, the Kiwi, the Norwegian krona, which have been outperforming this week, whereas the more traditional safe haven currencies of the yen and Swiss franc have been underperforming.
Yeah, got it. And despite no sign of a Fed rate cut just yet, the ECB meeting yesterday saw a seventh consecutive rate cut. We had Lagarde also indicating that the easing cycle was coming to an end. Euro's still pretty well supported and pushing back to within touching distance of 115 against the dollar. So what were the key takes from the ECB meeting, do you think? And where do you see the terminal rate?
Yeah, I mean, for us, we thought the comments from President Lagarde in the press conference were more hawkish than we had anticipated. She gave a kind of stronger signal there that they are close to the end of their rate cut cycle. Obviously, they've already cut their policy rate in half now, down to 2%. And at this level, it's consistent with what we've heard from the ECB staff. Their estimate for the neutral rate is somewhere between sort of 1.75 and 2.25%. So we're smack back in the middle of that range at the moment. So that gives the ECB confidence that they've kind of done well in terms of bringing inflation down and getting the policy rate back to neutral. So from that perspective, it's a job well done so far. But we still feel that there is room for further rate cuts in the second half of this year. Obviously, there is a risk still that trade disruption between the EU and US could worsen from here. Obviously, we still have the 9th of July deadline to see what happens with the higher reciprocal tariff rates. We think there's a higher chance that higher reciprocal tariff rate of 20% could be applied to the EU, which would then increase downside risks to growth and inflation in Europe going forward. So that could be a trigger for further rate cuts from the ECB in the second half of this year. And we also feel as well that the disinflationary pressure in Europe already potentially could surprise the ECB to the downside going forward, not just from the stronger euro persisting, the weaker energy prices, but there's also the possibility that we're starting to see evidence that we could see sort of trade diversion, where these tariffs the US is putting in place could mean that some of the exports from China are rediverted into the European markets, and that could put more downward pressure on prices in Europe. So we still feel quite confident that risks are more tilted to the downside for inflation in Europe, and we could be kind of going back into a regime kind of pre-COVID where Europe faced kind of inflation undershooting the ECB's target. So if we do kind of go back into that kind of regime, then there could still be more room there for the ECB to lower rates.
Thank you very much. Plenty to pick through from all that then. So I really appreciate your time and your thoughts as always. Thank you, Lee.
Thank you.
Thank you for listening to this MUFG Global Markets podcast. Rate, review, and subscribe, and contact your MUFG sales rep for more information. Join us again next week for more expert insights from our global markets research team.